This is the last question, question 4 on the practice homework 7 for module 11. So this is a multi-year forecasting example. This is a 2-year ahead forecasting. So we're provided with a consolidated statement of operations for target corporation and also the financial position. So one is the balance sheet, this one is the income statement. And then we have also provided with a bunch of assumptions used in the forecast, like sales growth rate and the fraction or the percent of the cost of sales to the sales, and so on and so forth. And we also need to be careful about these instructions. Forecast the targets fiscal year ended 2016 and 2017. Income statements use the same forecasting assumptions for both years, round forecast to millions. So that means we don't have to keep in the decimal places because all these numbers here are already in millions. And use rounded figures for subsequent forecast calculations, and do not use negative signs with your answers in the income statement. So that means that even for the expense items, we need to use positive numbers. A hint: forecasted fiscal year 2016 gain on sale is computed as proceeds from the disposal of net assets from discontinued operations minus net assets from discontinued operations. So this basically tells us how to do how to fill in the blank for the gain on sale. So that's one item on the income statement. Yeah. And for fiscal year 2017, that item is 0. And then we also need to read the information about how to forecast the balance sheet items. For example, this capital expenditure divided by sales, because this number will be used when we forecast the depreciation expense. Yeah, if we go back here, the depreciation expense, depreciation and amortization as a fraction, as a percent of prior year PPE net will be fixed at 8.4%. So this prior year PPE net for the starting year, fiscal year 2016, we can use this number 25 to 17. But after that, we need to figure out the new net PPE, and then we will need the capital expenditure number. And how do we get the capital expenditure? We can use this assumption: capital expenditure divided by sales will be 1.90%. So given the forecasted sales, we can also figure out the capital expenditure. And this dividends divided by net income will be used when we forecast the dividends. And then from that, we can also figure out the addition to retained earnings. And that number will be used when we forecast this retained earnings, together with the information about the repurchase of the stock. Like here, assume target buys back common stock at $2,000 million in fiscal year 2016 and retires the stock. So this tells us how much the firm plans to retire the stock for fiscal year 2016. And there's no such buyback activity for fiscal year 2017. So with this in mind, we can go and solve this problem. So let me first erase this. This comes from an earlier attempt. So let me just first copy the number to my Excel sheet. Copy the number there. And So this is the income statement, and for balance sheet, you can also do similar copy. So this is copying numbers. We can leave ample space for that. If we want, we can actually insert one more column here, because if you notice, more recent year actually is in on the left. So then we can just so this will be fiscal year, yeah, 2016 and fiscal year 2017. The same here for the balance sheet. So whenever we do the forecasting, we always start from the income statement, right? So the sales will be based on the current sales, which is this actually is fiscal year 2015. Yeah, because this is January 30th. That's the fiscal year end month for target. So this is going to be the current fiscal year 2015's sales level times 1 plus the growth rate of sales, which is 3% here. 3%. And I want to keep all the units here to be rounded to no decimal places. So rounded to the nearest dollar. Same thing for the balance sheet. Same thing for the balance sheet. Oh, I have to make sure the numbers here are correct. It seems that when I do the copying, something went not as expected. So yeah, it's actually correct. Just want to make sure. Okay, so now I can change the format to be keeping the rounded to the nearest dollar. Okay, so when I got the sales, yeah, I can, yeah, because the sale will grow at the same rate. So this is gonna be, yeah, fiscal year 2017 is gonna be fiscal year 2016 sales times 1 plus the same growth rate, right? Because the assumption here is that it grows at the same rate for both years. And then the next item is the cost of sales. Cost of sales will be 70.5% of sales, right? So that's the cost of sales, and then applying that to the same to also to the other year. And then the next item is the gross margin. That's simply the difference between sales minus cost of goods sold. And also pull the sale to the other year. And the selling, general, and administrative expense, that's going to be 19.9%. 19.9% times the forecasted sales, right? And then pull the sale to the other year. On depreciation, amortization, yeah, this will be determined by 8.4% of the prior year PPE. Yeah, this is prior year, so it's going to be 8.4% times prior year referred to the fiscal year 2015, which is by the end of January 30th. So in order to use a prior year net PPE, we need to go to the balance sheet. Yeah, basically it's the number here. It's no, it's 25,217. Yeah, that number there. So that's the depreciation amortization for fiscal year 2016. But then to figure out this fiscal year of depreciation and amortization for fiscal year 2017, we will need the information about the net PPE for fiscal year 2016. So how do we figure out this item? So we can use the formula that we listed on the PowerPoint lecture slide for module 11. Forecasted PPE, so this is forecasted net PPE, will be current net PPE plus forecasted capital expenditure minus forecasted depreciation expense. We actually have already figured out the forecasted depreciation expense for fiscal year 2016 here. So this net PPE will simply be, to figure out this net PPE, we will just need to figure out what is the forecasted capital expenditure. And so the forecasted capital expenditure will be determined by this assumption here, because capital expenditure divided by sales will be 1.90%. So with that, we can use the formula. It's going to be current net PPE plus forecasted capital expenditure. So forecasted capital expenditure will be 1.90% of forecasted sales, right? Because capital expenditure divided by sales will be the same, will be this constant. So if I use forecasted capital expenditure, I can also use forecasted sales as the denominator. So forecasted capital expenditure will be forecasted sales times 1.90%. Well, 1.90%, and then times the forecasted sales is right here, and then minus this depreciation and amortization expense. So that is the new PPE, net PPE. So with that, we can also figure out the depreciation and amortization expense for fiscal year 2017. And that's going to be the this net PPE for 2016. That's the prior year relative to 2017. And then times, again, going back to the assumption here, it's 8.4%, right? It's 8.4% of the prior year net PPE. So this is, yeah, I need to change all this to be rounded to the nearest whole dollar. So that's this is the new depreciation and amortization. And the gain on sale, again, that's directly provided by gain on sale for fiscal year 2016 is going to be 350 minus 226. So this is 350 minus 226, so 124. And it's going to be 0 for fiscal year 2017. And earnings from continuing operations before interest expense and income taxes will simply be the difference, right? Difference between gross margin and SG&A and depreciation expense, depreciation and amortization, and then plus gain on sale. Yeah. So And then we do the same for the other year. And next item is net interest expense. So let's still go back to the assumptions to see how we can figure out this number. So interest expense is no change. So we just assume it's going to be the same as the most recent year. And then we do the same for fiscal year 2016. 2017. Earnings from continuing operations before income taxes. So that's simply the difference between the earnings from continuing operations before interest expense and income taxes and the interest expense. And then pull the cell to the other year, we get the number there. And provision for income taxes, and this will be based on the taxable income and this tax rate, right? Provisions for income tax divided by pre-tax income. So this 32.5% basically is the tax rate, then times this taxable income, and then pull the cell to the other year. And finally, net earnings from continuing operations. Not finally, this is the difference between the earnings from continuing operations before income taxes and this income taxes here. Right? So that's going to be this number. And discontinued operations net of tax. So that I believe that's transitory. So if you notice here, actually, in the final answer, this balance sheet, there's no such item. So we can just I guess this basically is the net earnings. This is the final bottom line because there's no such discontinued operations anymore. So now we can just copy the number. Yeah, copy the number back. But when we copy the number, we should notice that actually here, the fiscal year 2016 is on the left, fiscal year 2017 is on the right. So we need to be super careful. Yeah, and then we need to, actually, I don't know whether I can copy 3 numbers at the same time. Guess not. So I have to copy each one by one there. And then cost of sales there, and gross margin there, and SGA, and depreciation and amortization, and gain on sale, and earnings from continuing operations before interest and taxes, and net interest expense, and earnings from continuing operations before tax, and this number, and finally the net income. So we do the same for the other year. Copy the number there and just make sure we copy to the correct blank to the right place. Yeah, this is going to take a while. There's a lot of number there. I'm done with the income statement. So now let's get to the balance sheet. So balance sheet, first is cash. Yeah, cash, again, that's a plug variable, right? We leave this alone for now because later on we can figure out this cash based on the other, based on the balance sheet identity, right? So first one is going to be inventory. So inventory divided by sales is going to be 11.7%. and then we simply multiply that by the forecasted sales, and then we can get the inventory, right? And then the assets of discontinued operations. I don't think, yeah, you can see that from this final answer sheet here. Actually, there's no such item, so we can just get rid of this row here, because that's also transitory. And then the next item is the other current assets. So this is gonna be 1.6% times, yeah, it's 1.6% times the forecasted sales, right? So we move this to the next year, and then we move this to the next year. And hence the total current assets, we can also leave this alone, because this will depend on the cash, right? We don't know the cash yet, so we can just leave this alone. And net PPE, yeah, we have already figured out net PPE for fiscal year 2016. We can also use the same method to figure out net PPE for 2017. So it's current net PPE plus forecasted capital expenditure, right? Forecasted capital expenditure will be, again, let's check the capital expenditure divided by sales. That's 1.90%. And then times the forecasted sales, right? We should use the 2017 number now. And then that's going to be forecasted. So far, this is the forecasted capital expenditure. And then we should subtract the depreciation and amortization. It's right here from the income statement. So this is the forecasted net PPE for fiscal year 2017. And non-current assets of discontinued operations. I believe there's also no such item on the final answer sheet. So we can just leave that alone. Yeah, get rid of that item here. So other non-current assets. Other non-current assets divided by sales will be 1.1%. So this will be equal to 1.1% times the sales. Yeah, move this to the other year. And total assets. So total assets obviously will be the sum of all these items. But the problem is that we don't know the cash. We don't know the cash yet. So we also we don't know the total assets. So let's just leave that alone for now. And then accounts payable. Yeah, we go to the other side of the balance sheet. Accounts payable divided by sales will be 10.1%, equals 10.1% times the forecasted sales. And then we move this to the other year. And accrued expenses and other current liabilities. Accrued expenses and other current liabilities divided by sales, that's going to be 5.7%. So it's 5.7% times the forecasted sales. And then we move this to the other year. And current portion of long-term debt and other borrowings. So current portion of long-term debt. Here we will need the schedule on the retirement of the long-term debt. So current maturities, long-term debt for 2016. This is already reflected on the 2015 number, I believe. It's let's see whether 2015 the current portions of long-term debt is yeah, this includes the current portion of the long-term debt, or which will become due by the end of 2016, fiscal year 2016. So that's this is already reflected. 751 is already reflected in this current portion of long-term debt and other borrowings. So if we make the assumption that other borrowings will be the same for the next fiscal year, then we can use this formula, which we talk about. We also listed that formula in the PowerPoint lecture slides. Forecasted current debt, so this means the current portion of the long-term debt, equals the current portion of the long-term debt minus next current maturities of long-term debt plus 2 year ahead current maturities of long-term debt. So in this case, when we use this forecast, this is going to be current, which is the January 30, 2016 or fiscal year 2015 number, and then we will deduct next current maturities. So next current maturities is gonna be 2017 number, current maturities of long-term debt for 2017. So 2,251. So 2,251. And then we need to add back. We need to add the 2 year ahead current maturities of long-term debt. So we need to add 2 year ahead. Actually, here I think this number here should be fiscal year 2016. That's what this next current maturities of long-term debt here refers to, because next is in terms of the current year. The current year here is fiscal year 2015, so that's why this 2016 number is the next year. So that's what we should use. So this is going to be 251. No, 751. Sorry, it's 751. 751, and then we should also add the next year's 2,251 number. So, and that's gonna be the current portion of long-term debt and other borrowings for the next year. And then for the 2 year later's number, 2017 number, that's gonna be current again using the same formula. But then we should subtract 2,251 and then plus the 2018 number, which is 201. So that's going to be current portion of the long-term debt. And for the long-term debt, we can just directly go to the long-term debt and other borrowings. So long-term debt will also be based on the current level, but then we should get rid of the current portion of the long-term debt. So for the next year, we should get rid of the current maturities long-term debt for 2017, right? So that's going to be 2,251. 2,251. We'll get rid of that because that part is already reflected in the current portion of the long-term debt. And then for the fiscal year 2017, again, we need to get rid of the amount 201, and that's the. And we also need to be careful to see whether there's any assumption provided by the setup that the firm will issue some new long-term debt. If that's the case, then we also need to add that new issuance of long-term debt. But it doesn't seem to that's the case. So we can leave this as this. The liabilities of discontinued operations. Again, I don't think this one is relevant for the final answer sheet. So that's what, yeah, that's what that's exactly the case. And total current liabilities, yeah, here we can calculate the total. It's basically the sum of the three here: accounts payable, accrued expenses, and the current portion of long-term debt. And then pull the sale to the other year. And deferred income taxes, again, we can see with the better what's the assumption there. Deferred income taxes divided by sales, that's going to be 1 point. Yeah, it's going to be 1.1%. So times the forecasted sales, and then pull the sale to the other year. And non-current liabilities of discontinued operations. So this also is not relevant, I believe. So let's double check. Yes. So other non-current liabilities. So other non-current liabilities divided by sales will be 2.6%. So this will be 2.6% times forecasted sales. Okay, so this is gonna be 2.6%, 2.6% times forecasted sales. And then other non-current, yeah, so the total non-current liabilities, this is basically the sum of the three items. And then the total non-current or shareholders investment. So here, this section includes common stock. I believe the assumption here is common stock doesn't change. Yeah, that's the, I guess that's the default assumption. Yeah, the common stock doesn't change. So this doesn't change. And this carries over to the next year too. And additional paid-in capital also doesn't change. And retained earnings. This part will change because the setup says that retained earnings are reduced by the cost of stock buyback, right? And before we add, before we deduct the cost of stock, I mean the stock buyback or the treasury stock, we also need to know that the retained earnings will increase by the amount of addition to retained earnings, right? So addition to retained earnings will be based on, so dividend. And dividend here will be based on this dividend rate. The dividend divided by net income is 40.5%. So this is going to be 40.5% times the net earnings. Again, let's format the cells, keep no decimal place. And so addition to retained earnings. This is simply the difference between the net income and dividend. So we pull the cell to the other year and to the other year for the addition to retained earnings too. So why do I do this? Because this addition to retained earnings will need to be added to this retained earnings number. So this retained earnings number will be the current level plus the addition to retained earnings, and then subtract the share buyback. So it's assumed that there's 2,000 million in fiscal year 2016. So I need to minus 2,000. So that's my retained earnings for fiscal year 2016. And then for 2017, it's gonna be the same in the sense that the formula is the same. It's gonna be the current level and then plus addition to retained earnings for fiscal year 2017, and then minus there's no share buyback, so minus 0. So that's the new retained earnings. And accumulated other comprehensive loss, I believe that's gonna be why there's no such information there. Oh, it's because that's broken down to these numbers. So let's check whether the I guess there's no change for these numbers. That's assumption here. No change. Yes, that's assumption. Common stock, additional paid-in capital, and that's also no change. So this is gonna be the same as this one, and same as this one, and this is that and that. So accumulated a comprehensive loss will be the sum of these two numbers, basically. And total shareholders investment, this is going to be the sum of common stock and additional paid-in capital and retained earnings, and finally this accumulated other comprehensive loss. So then we pull the cell to the other year. And finally, total liabilities and shareholders investment will be the total liabilities. So that's going to be total current liabilities. It's right there. And then plus the total non-current liabilities and plus the total shareholders investment. So finally, the only variable which we haven't figured out is the cash. So how can we figure out the cash? We can figure out the cash based on the balance sheet identity. So we can use that this equals, because the total liabilities and the shareholders equity, shareholders investment will have to be equal to the total assets. So total assets will be equal to the cash plus other items on the asset side. So we can use that equation to figure out the cash must be equal to the this total liabilities and shareholders investment minus the sum of all these asset side numbers. So that's gonna be this total liabilities and the shareholders equity minus inventory minus other current assets, and then minus net PPE and minus this other non-current assets. So that's basically what this is. Yeah. and then pull the cell to the other year. So now we can calculate the total current asset, which is the sum of the cash, inventory, and other current assets, right? So then pull the cell to the other year, and we can also figure out this the total assets. The total assets we can just equal to the total liabilities and equity, or we can sum up these numbers. We can get you will see that these two methods will give us the same number. So now I guess we are done. The rest of the job is simply to copy the number to the right place. So this is the numbers which I copied here just to save some time for the recording. So let me check my final answer here. You can see that there's some parts of the answer which are marked as incorrect, but this is actually not due to that we did the question incorrectly. This is actually due to the rounding issue by my business course. So if you have the similar issue, I'm going to add your points back. You can check that for each of these answers, it's just maybe $1 off. I guess that's based on the rounding, small rounding issues. It's okay. In particular here, the accumulated other comprehensive loss, the my MBC only accepts positive number, but this is not so clear because if you read this instruction, it says do not use negative signs with your answers in the income statement. It doesn't mention that for the balance sheet, because this is balance sheet. By balance sheet, you cannot use negative number. It turns out this should be a negative number, but you can see that the correct answer is just a positive number. But that's not what the instructions have given us. So with that, I'm gonna stop here.